Hi, Han. Thank you so much for coming to the Venture Talk series. How's it going?
Good, thank you. And thanks for having me, Max.
My pleasure. As we start, this podcast is done more for investors, of course, to talk about how do they invest money, but we very much are focused on tell the story to the founders. So let them understanding how works venture capital, how what's the investor view on how they would like to invest money in founders, in startups, and so on. That's the aim of podcast. Uh, Before we start, you want to give an introduction to yourself?
Sure, happy to. I actually quite recently, became an investor because I've been a tech entrepreneur for the last 20 years. So I started my career in academia. I actually started a PhD in AI 20 years ago, longer for the hype. 20 years ago, there was zero hype in AI. Take my word for it. Now it's AI left, AI right. It's AI everywhere. I love it. This is 20 years in the making. But so I, but born and raised in Sweden. But I started companies, had one exit, lived in Silicon Valley for many years, and about a year and a half ago, I became general partner in a VC fund here in Stockholm, Sweden, called Norrsken, and we invest in the early stage.
That's great. Where exactly in the early stage you invest? In very, very early or more in mature stage? Let's say late early, maybe A, B round?
No, we invest like pre-seed seed stage. So we invest quite early. What we like to see in place is that there's a team. We would like to see that there is a at least some kind of product in place, and ideally some revenues, not much revenue, but we'd love to see some customer feedback on the product. But quite early.
In terms of sector and geography, where are you more oriented to
Hmm?
deploy your money?
So at Norrsken, we are an impact investor, meaning we are investing in the founders that are on a mission to make the world a better place. But impact for us is broadly defined. So it's all of UN's 17 SDGs. So it's not just climate, even though for the last year or so it's been heavily skewed toward climate. But we can also do education, we can do health tech, we can do a lot of equality, a lot of different sectors. And from a geo perspective, our mandate is global. So we invest all over the world. Naturally, where we have get the most deal flow is where we have physical houses, because Norrsken is one of the leading impact hubs in the world, and we have physical houses in Stockholm, Sweden. We have one bigger property in Rwanda, in Kigali, and we just opened up a house in Barcelona. So that's where most of our deal flow is in Europe and in Africa, then some in North America, South America, and some in Asia, but we are the strongest in Europe and Africa.
So your aim focus is Europe and Africa when it comes to
I
investing.
would say so. Yeah, yeah.
And what about the ticket? I mean, what's the average ticket are you deploying now?
So since we invest early stage, we have a set ticket. It's 125K. So our model is very similar to the Y Combinator model. So we invest in the companies, we'll take them through an 8-week accelerator program. Um,
Okay, so you are pretty much hands-on, yeah, when it comes to
we
investing.
are very hands-on in the when they are here. The program runs. It's a physical program here in Stockholm, so everyone flies in for the 8 weeks here, and we really see this working because when they're here, they're at the same. We're set up we're a living space for them, so it really creates a community amongst entrepreneurs. Because a lot of questions they are facing, issues they are facing, the other companies that are at the same stage, they are facing the similar challenges, right? So I think there's strongly believe in building a community. But naturally, we are also very hands-on for the 8 weeks when they are here. We match them with, we have a network of 100 mentors. all ranging from unicorn founders, operators from Spotify, Klarna, the other unicorns locally here. So, and also VCs, we have a huge VC network that we hook them up with and stuff like that. So when they're here, we're very active. Then we cannot be very active over time because we've done in our fund, the fund I'm in, we'll do 180 investments. We're a small team. We've done 60 already. So we don't take board seats. We are not even an observer on the board. So we're very active in the first stage, the formation stage, but then we are quite passive.
I mean, I have my opinion, and I do believe funders must be accelerating somehow at the very beginning, especially to give them some kind of orientation where to go. Many of them are very young and are very with no experience at all. So I truly agree in what you guys are doing because it's very helpful for them. And there is not that much help outside. A lot of talk, but very little action in reality. But in terms of considering to invest in startup, as you invest early it's about team more than anything else because we all know ideas without executions are the proxy or nothing. And how do you consider investing? Which are the main things, the main, let's say, rules that you have to follow? I mean, what funders must have for you to invest in them?
I think when you look at our scorecard, because we have a scorecard where we score all companies, team naturally is a key part because we're doing early stage investing, and if they are not figuring out the idea that they are presenting, they'll make a pivot, and a great team will figure something out. So of course it's a huge plus if they've been a serial entrepreneur, if they've done it before. It's I know myself because I started 2 companies. And I was a lot smarter. I did things a lot better the second time compared to the first
Oh
time.
yeah, sure.
So there's naturally a big plus. But then it's first, since we are not a generalist. Since we invest in impact, we really want to feel that they are solving a real problem. And many of the companies we invest in, it's a deep tech. Some of them have PhDs. They really have very strong domain expertise in something. But then they also must realize, because that also means that they have other blind spots.
Yeah.
So with the accelerator program, we really try to help them on the business side, how to get sales going, how to do marketing and stuff like that, where they're typically not super strong. So in the interviews, I really like founders that are, of course they have to be pushy, right? Because if you're not aggressive, you never succeed, right?
Correct.
But I really also would like them to be humble in them knowing that they don't know everything. Because if you see, if they don't really I'm not sure coachable is the right word, but if they're not open to feedback, we might not be the right investor for it. It's really a balance, Max.
It's not
It's
easy.
because naturally we want them to be very aggressive, and they should be come hell and high water. We'll make this business succeed. But again, yet humble enough to realize that they need to team up with others that are experts in other areas too. Because the brutal fact is, making a company succeed is a teamwork. It's never, even though the founder or founders get all the attention in media, it's always a team effort, right? And the smart founders are the ones that team up with, know that they have knowledge gaps, and team up with the people that can help them and their company succeed. So that I don't. This is hard to quantify. This is hard to. But when we do the interviews with the founders, you get a good feel for this quite early.
You're right, but this is a very thin line between. It's very difficult to find big-headed founder. You must be big-headed. There is nothing to, otherwise you will never go through all the
Nope.
up and down, highs and lows. It's too painful. At the same time, you must listen, right? And for big-headed people, listening is a very problematic. And
Yep.
that's what it is. So it's finding this kind of trade-off. It's not that simple. It's very complicated.
And also, when we make investment decisions, we are a venture capitalist. We are looking for outsized returns.
Of course.
I don't think a lot of founders understand what that really means, because all this talk about markets, how important is it really? It turns out that it's of great importance. So what we say at Norrsken, what we're looking for is companies that have the potential to become impact unicorns. That means that first they should have the potential to become a unicorn in the traditional meaning that they can be worth $1 billion.
Yeah.
But also, we want to invest in companies that can potentially impact 1 billion people's lives. So we're putting the bar really, really high in the companies that we are investing. We would not invest in a company if the addressable market is too small. Even if we love the company, even if we love everything, but if the market's too small, it's not really a VC game, because we know that the dynamics is brutal. When we do the math, probably 70% of the companies that we invest in will go bust. It is brutal. We do early stage investing, which means that the ones that are succeeding, they need to deliver the return on the fund and then some.
I mean, I think it goes to education. Many founders, they don't come from this environment, so they go out and searching for money because they know that that's the way, right? Let me try. And as I said to many, you need to understand if you're right for an investor in venture capital, because I mean, why your friend and family and whoever they are, they don't need to give money back to their P. Maybe venture capitalists, they must. So if they got one, maybe they need to go back at least three, because they handed the money for pretty long time, 5, 10 years. So these dynamics, they are not there for them. I think they must be taught, because this is how this is why we do this podcast, because at least when the founders be in EquityMatch or even outside in our YouTube channel, they watch this video, they understand what actually means talking to investors and what is the dynamic behind an investor way to invest, right? Which is, I need to give the money back one day, and I need multiples to be delivered by the startup. And one must pay for 50 because the other 50 probably will die. And these are these kind of dynamics that they don't know. It's pretty normal, right? That's why probably 2, 3 times fund they already went to, they know what to do. They already prepare how to deliver the next one. I was
Oh yeah.
watching last night, when I had some time, the 2018 documentary on Elon Musk. I mean, it's crazy because I mean, it's very, very little people got 160 million from PayPal and reinvest all the money in 3 startups or his money. But this is why he's there today. He took so much risk. But what he did after was much better than what he did before. So failing, it's a big deal, and this is why investors, they like to many times to invest in fund that already failed, so they know the pain, they know where to go next.
And also, since this is a bit about educating the founders, another thing we have on our scorecard is cap table.
Yeah,
And then one can question, okay, how does that really matters? It matters a lot, because if we don't see at the pre-seed seed stage that the founders own the majority, I speak close to 80% of the company, it's a red flag. It's a showstopper for us, because if they decide to go down the venture route, again, it's not the only way to finance a company. I should say that it's venture is not for everyone. There's definitely other ways of funding companies. Venture is just one way. But if you decide to go down that route of taking on venture capital, you probably will raise pre-seed, seed, Series A, Series B, Series C, and which means that you need to be able to maintain as much as founders as possible for as long as possible. Because if you come to a Series A and you're down to like 20 or 30% the total management. It makes it really, really hard to actually to attract venture capital into the company just because of the fucked up cap table. So, and it's not just about the ownership, but especially since this market is a little bit sour, it's a difficult market. You see, like there are preferences at pref shares at earlier stages, and it's not just about the valuation and keeping an ownership, but if there are things that complicates for investors, like if there are multiple different share classes and stuff like that, makes it hard for investors to invest at later stages. So we really would like, when we invest, because we're investing so early, it has to be really, really clean, no difficult structures. The founder should own the very majority of the company at this stage, which also makes it hard for us to invest in companies that have been around for a bit. Because typically, if you brought in some angel money, friends and family in the beginning, and if you've done a pivot, if you've been around for 5 years, it can be hard for us, even though we love the idea and love everything. But we quite often say no because of the cap table.
I mean, I think when the funders go to venture capital, this is my personal opinion, but they really need education because they demand, for example, anytime I talk to funders, they come to me. Sometimes I do some angel, but now I'm fully invested in my startup because I'm before an angel, I'm a founder. Before an investor, I'm an entrepreneur. This is, I think, my sixth startup. And but I always said them, if you give up 30% in the first place, for the first 100K, 50K, there's nothing left. Come on. You got another pre-seed round, seed round, you're probably 30. There is no way you find any A round because who's going to invest in a fund that has nothing or less than nothing in a company? There's no commitment at all. But they don't know this dynamic. That's why it's not their fault, but it's the system that should tell them how things work in the first place before they move. For example, in your opinion, I mean, not your opinion, you invest pretty heavily actually, over 100. How much do you believe an angel should take before coming a venture capitalist accelerator yourself? You're already doing your business in a professional way, okay? This is your job. Angels, they normally invest some ticket because they have some spare money just to commit and maybe finger crossed to get some money back. So, what is in your opinion, how much fund they should give up in terms of share at the very beginning between friend and family, and maybe some angel around, and coming to you asking the money to you guys, which I invest in pre-seed, which is, for me is the most difficult part of the fundraising is pre-seed because 90% they have no traction at all or very little.
Uh, I would say that around 10-15%, but that money should actually get you to actually have a working product, a prototype, something that you could put in the hands of customers and get some feedback from the market. Ideally some paying customers. So to get to this stage, 10-15% roughly.
Yeah. I think many of them, they're already 30, 35. When you get to this stage, you already lost pretty much, unless they bootstrap. Maybe it's the best way.
On that very topic, something, and this might be just because we are an impact investor, but we see some founders these days being really, really smart at getting grants. And as an investor, that's wonderful because that's non-dilutive capital. We've seen companies actually been able to get some significant money through grants, and which is great. Not everyone can because it depends on which sector you're in. So it's not like all sectors where you can actually find grants.
Yeah,
but if you're in a sector where there are grants available, I think as a founder, it's a very attractive opportunity not to be diluted yourself and make it a lot more very, very tasty for investors to venture capital to come in if you as a founder been able to go quite far without having to bring in too much venture capital already.
You're very right. And also grants, or if they can get, because the other problem is I see whatever it takes as long as I get some money. So getting loan at the very, very beginning, for example, I'm very much against any form of convertible loan note. I do believe funding must get safe. Now, in Europe, when you talk to investors, and happened to me, because actually I commit my money. I called some friend and family, some my friends said, you know what, I'm doing EquityMatch. Do you want to jump in? So we put together 250K. We launched the EquityMatch. Actually, now we are doing another 250K. But happened to me that when you move to fundraising, a lot of investors, they would like to be somehow covered, right? And they tell you, okay, I want a convertible loan note. And I said to them, what's the point? You're giving a loan to someone who makes no money at all. So what's the how do you want to get your loan back? It's useless. That's ridiculous. And you're putting the burden or loan on these guys when they're very early. They have already debt. They go to someone else and say, okay, I need 100K, but I'm sorry, I have 250K in debt already. That's working this way. I believe STEP must be the only way to fundraise fund at the very beginning until someone like you comes, understand the business, understand the valuation, and give the valuation, and you will be converted for the valuation given. This is the only logic must be behind startups. But in Europe, we are still behind on this. For me, this is my opinion. But what's your opinion? Because I see very, very reluctance when it comes to save. For them, it's like giving the money
Yeah.
with, I don't know, blind eyes, something similar.
No, we are super disciplined when it comes to structures and valuations, and because we are institutional and investor right, and we need to make sure that we return money to our LPs. So uh, if it's too high valuation in at the pre-seed stage, we say no. And there are good benchmarks out in the market. Of course, there are some founders that ask for, oh, we are worth this much, but they really have no data to back that up yet with, right? Because it's a pre-seed stage. So, and also since we are doing 180 investments, no, too high valuations, it's also an immediate no for us as well. Should be fair, for sure. So it's not like we're trying to squeeze anyone, because that's not the right thing to do either. But so we definitely try doing a lot of benchmarking, and we want to make sure that we are on at market. Uh, but if it's a company with too high valuation, we are with our model doing that many investments. We just say no.
If I remember well, it's 150 your average ticket.
Yep.
So which means you don't take any valuation below 2.5 million, right?
So we want to we are. It's not that we have a set ownership target, but around 5%.
What about proximity? You bring funders up to after the investment in your program, 8 weeks program, but what happens before? Do you invest in a full remote due diligence without even meeting the funders one day, face to face?
Yes, we do.
So the proximity and be or close to you doesn't bother you that much.
Nope,
Okay.
not at all.
After investments, of course, you have them 8 months, 8 weeks. So they're there. There is nothing to talk. What happens after? Do you meet them? You don't taking any board seat. You don't supervisor. You don't do anything of this. But how do they report if they report to you?
So they report us twice per year. And so they report on if there's the financial performance, if the fundraisers, and also since we are an impact investor. During this 8-week program, we define, here's the KPI on which you will report your impact. So that's part of their framework for reporting to us. But then no, we're not active, but naturally, I think as an owner in a company, you should do whatever you can, right, to help them.
Of course.
But knowing that we'll have very limited bandwidth, I think where we can add the most value is when they're doing the fundraisers, because we have since we're collaborating with so many later stage VCs. We have a huge network of VCs that we can connect them with, and also helping up with a little bit of the matchmaking. Here's the write-off. Here are investors that like your space, where you are, etc., etc. So do a little bit of matchmaking. That's where I think that's where we can add the most value, because adding value some other areas will take more time. We'll probably need some more bigger team, more domain expertise, etc. So where we can help the most is around the fundraising.
May I ask you, what is about these 8 weeks? Where actually a focus on in these 8 weeks they come down?
It's a very good question, and we thought a lot about this, because we don't want to be. This is not a. We tell the founders, this is not a school. This is not a startup school. So before they come here, we interview them and ask them what are their needs, and then we try to tailor the program for the companies. And we try to match them with mentors that have expertise that they are lacking. So the program is more or less, we have every batch, we have 20 companies come here. And so there are a few things that are mandatory, though, and during this 8 week. And one of them is pitch coaching. Because I can say this because I've been in Silicon Valley for so many years. European companies typically suck at pitching. Definitely compared to American companies, they're so much better. And one can say, well, does that really matter? Yeah, it matters a lot, because to be able to fundraise, you need to be able to articulate your deep, but it goes beyond that. But also to doing hiring. Hiring is competitive. You want to be able to attract rock stars to your companies. You need to be able to tell a good story. So pitch coaching is mandatory. Then everything related to impact, since we are an impact investor, so the impact reporting that we talked about, the KPIs on that's also mandatory. Then more or less everything else is the founders decide, I want to join this session, I don't want to join this session because it's not relevant to me. Most of them attend all of them. We do a lot around fundraising. Because that's where we're really expert, right? Because that's what we do for a living. So most companies attend everything fundraising related, because that's definitely in their interest. But the rest is because we do B2C, we do B2B. So some B2, if we do a session around B2B sales, it might have been relevant for B2C companies, etc. So we try to tailor the program for the companies that we invest in.
They need the money. In order to fundraise, they need to pitch correctly. And you're right. I mean, in Europe, we still pitch in a way that can be a lot improved. But we're getting better. Before it was terrible.
Yeah.
Now it's for sure it's getting better and better.
Much better.
Do you take a round that are bigger than your ticket, which means are you co-leading or co-investing with others?
We are super flexible. Typically, most often we co-invest, because I think it's a very different. Because if you look at very early stage investing, it is not that competitive. When you do Series A, Series B, Series C, super competitive. And typically there's one lead and there might be room for one or two to follow, but that's it, right? In the very early stage, since our ticket is 125K, it's great if we can team up with 3-4 others, so the total ticket size is around $500,000. Mm-hmm. Because ideally we like to see a company to get 12 to 18 months runway. And with a small team, and typically they don't have that much revenue at the early stage. So if the total ticket size is around $500,000, they normally, if the team is not too big, they get about 12 to 18 months. So we actually have a preference of co-investing with others. And sometimes we lead, sometimes we just follow. We are super flexible when it comes to that.
I mean, what about, for example, I don't know if it's your case, when I talk to corporate VC, they like the portfolio having some kind of interaction, which means they actually can sell to each other, they can work together to build something even bigger. Does it apply to your portfolio?
It's a very good question, and don't really have the answer for that. I think long term, yes, but where they are when we invest, they need to figure out their own stuff first before they can actually talk about partnerships and collaborating. I think so. Maybe later stage. I'm all for building this community amongst where entrepreneurs can collaborate and share ideas and help each other out. Uh, where it makes sense from a business perspective, where they can partner up. Probably a little bit later than at the stage we invest.
Can you articulate to founders where they really find complicated for what is my experience, understanding when time to pivot arrives? So many founders are reluctant to pivot. They don't want because they perceive pivot like, all right, I was wrong. For me, big-headed, be wrong is not something that I really like. Although my idea of entrepreneur is exactly the opposite. Okay, I was wrong. Let me shut down everything. Let me start again, or let me turn before it's too late.
Yep. That's not an easy conversation to have, but this is probably because of my math background. I try to go look at the numbers, because if they've been doing something for some time, and whatever metric you're tracking, if it's monthly active users or recurring ARR or MRR, whatever metric you're tracking, and you've been on it for 12 to 18 months, and the number is not moving, clearly it's not working. So trying to leave the emotions aside, I'm pointing them to look here, look at the graph here. It's not moving, it's not happening. And I think that's the best thing you can do, because naturally, and you should be stubborn, etc., but you at the same time you shouldn't be foolish. If it's not working, it's not working. And I think the best way to show that to the founders is by looking at the numbers that are important for a company. If you're not moving your metrics, it's clearly not working.
Data talks. That's it.
bullshit walks. Yeah.
There is nothing to talk. I mean, let's say you had three startups, very similar, very similar.
Hmm?
Let's say you selected a few startups and founders. You had the last three very similar, very competitive. What triggers your decision? You can invest only one. What really are the key factors? Okay, let me go with this guy and no with this guy, although they are very close to each other. There must be something that really, because in pre-seed, gut works a lot. In pre-seed, founders, they really work a lot, the character. If you have people you can talk to, you can, as you said before, you can teach something. But at the same time, the idea must be an idea that makes sense. And execution must be seen, because at the very beginning, you see very little execution, although maybe there's some traction, but it's very little. And we know perfectly well for scaling the money. Without money, you cannot scale.
It's a good question. I think it's everything looks identical from a KPI perspective. It boils down to the rapport you get with the founding team, your gut feel. I've been an entrepreneur for 22 years or something like that. I've seen a lot, and I do trust my gut feel on this one.
Yeah, at the very beginning, it's very much about gut feel. Uh, you were saying before that you teach them how to pitch. What would you like to see if a founder coming to you pitching? I know there is not the perfect pitch; it does not exist. But if someone comes to you pitch you in 2, 3, 5, 4, 5 minutes, what are the key points that founders might really talk about, and not all the story, which is too long?
I think this is we're probably a little bit biased here because we are an impact investor, but I would like to understand that they are solving a real problem, and so that's number one. Second, I want to understand how they are uniquely positioned to solve this problem, and third one, I want to see this as big market, because if it's a fantastic but it's small, I'm not interested. You don't get it's not a VC game. So those are the three things: solving a real problem, uh, describing to me how you're uniquely positioned to actually solve this problem, and then you're going after a huge market. That's it. Because this is but if it's a space with a lot of competitors and stuff like that, then that boils down to execution. As long as you're uniquely positioned to solve something better than competition, the best solution will likely win long term. So if you explain these things, and if that's also why it's so important that there's a huge market, because if it is competitive, there might be room for a lot of players. If it's a small market, it might be that only one can make a living to become a sustainable company in a smaller market. That's also why it's so important that the market is huge.
If you can suggest to funders how to approach venture capitalists, many times they just really much go email to everyone and maybe someone will come back. How they must do some kind of research, correct?
Completely. And I think I really like when founders have done their homework. And frankly, it's not that hard, because most firms, including us, you see the people working for the fund. You can see their backgrounds. You can go to their LinkedIn. You can see at what stage they're investing. You can see geographies that they're investing. You can see what they like. Typically, there's something around the thesis for the fund, etc., etc. And you can't. If you're not a match with the VC, it's a waste of the founder's time. Time is very, very precious for founders, but it's also a waste of time of the VCs. So really, really, really do your homework, making sure you're talking to the investors that can actually invest in your company. Then, since there's a lot of competition for money, especially these days, take the time making sure you get a warm intro. Typically not that hard, because I guess you're getting bombarded, I am getting bombarded, but if you get a warm intro from someone I know that speaks highly about the person, I'll always take that call, always take that meeting. So checking that there's actually a fit with what they're doing and the investor, because if you don't, you look stupid. And but really try to get a warm intro. That helps a lot.
What about IP? Not everyone needs an IP when they start a startup, but some of them they really need, and they need to protect it. So, do you invest in startups that they do not have any form or intellectual property?
We do. But since we are coming back to that, we are an impact investor. Typically, there is some IP there. So most companies have some sort of IP. At our stage, how well it is protected and stuff like that, typically there's work to be done at our stage there. But we'd like to see some IP there. But we also made investments where there might not be that much IP.
Let me close with 2024, let's say 2025. So, okay, you're right. As you said at the very beginning, you've been talking and approaching AI 20 years ago. Today, it's just about AI. I didn't see any startup for the last 6 months starting, we use AI. I didn't see one. Everything comes to AI. Although they maybe they don't even need AI. Many times I struggle even to understand why they are talking to me AI is not needed at all in what they're doing.
Tell me about it.
It's unbelievable, but I understand because they believe the investors now only invest in AI. But take away AI or startup AI enabled. But which are the sectors that you believe, the sector in terms of industry, that you believe will be very trendy in 2024 and 2025 to invest in, where the bulk of the money in venture capital will go? Take away AI as a technology, but I'm not about technology. I'm talking about sectors, industry.
I think again I'm probably biased, but I truly believe that there is the next wave will be companies that are uniquely solving real problems. There was a great uh, deck by someone, I forgot his name, but he wrote that the VC factor is dead, where you invest in a company, you take it to the next round, you take it to the next round, there are set valuation multiples, and then you IPO. Now the IPO market, it's not there anymore. But if you're actually solving a real, it might take a little bit longer time to get there. But I'm a big fan of. I'm not sure I like the term deep tech, but I would say companies solving real problems, and, and but it's not just, we do a lot of investments in climate, and we do see some of our companies getting extreme tailwind from regulatory changes, which is great. We might not invest because of that, because generally they should have a good business right in the beginning, but. I think there will be a resurgence of companies actually solving real problems. And before, most VCs, they don't software only. I think for solving some problems, there needs to be some kind of hardware involved. And so I think there will be more hardware investments. But we like the combination. If for us, if it's hardware, it's great that it's combined with some kind of software. But I think we're going back to not another SaaS-based HR platform. I think we will see more companies actually solving real problems.
There are, I totally agree. There are a lot of founders. I have to say, in in EquityMatch, we've been running 100 pitch events. So we brought on stage something like 450 founders in 16 months. So I've seen so many decks, seriously, thousands of decks between screening, all this kind of stuff. I have to be honest, probably. I'm not even sure we are there. 1% are hardware, 99% are software. At this 90 software, I mean, whatever it takes that is not hardware, whatever. It can be a platform, can be a website, can be whatever it is. But uh, it's very difficult to see very much articulated idea. They are very general. They don't go even straight to the point. That you need to squeeze your brain to understand actually which problem they are solving, if they're solving any. Or you're just doing something because you want to bet, and maybe if you are lucky, you get some money. But as you say, we are far away from hardware. And also, I do believe VC are themselves far away from investing in hardware. Maybe because they don't understand it much. Hardware is difficult to understand for many. Back to Elon Musk, he was an engineer. This guy, extremely talented. So for him, it was much easier to understand what actually was lightning engineering, building Tesla, and all the other. But not everyone is Musk in terms of capability. Not everyone is Musk in terms of persistence, because you need to be almost mad to do what he did. It's not for everyone.
Yep,
Not everyone can pay.
100%.
You
No,
can't use 170 million. I think he's the only person who reinvested under 60 million, because everyone who bought Villa, Ferrari, Lamborghini, and maybe had some fun. He didn't. But back to the hardware, there is uh, very little doing in this aspect. But I, 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 I don't understand, is because the trend is not there, because founders maybe believe, or because that investors prefer to invest in software, maybe it is the case, or because they don't have enough skills to build something strong in hardware. What's your opinion? And we close here.
no, I think it's definitely about skills. Doing hardware is hard, right? It's not that it's easy to do software, but I think traditionally there's been more investment in software, but also I think it's also for VCs now starting to realize that, hey, we actually need a little bit of hardware. So I think it's a little bit education and also showing that this is what we're interested in. Uh, because some can say, oh, hardware, it's hard from a capex perspective. That doesn't really work with the VC model. But I think it does, because we have companies in our portfolios. They will have to build like factories to building the stuff, right? But that part can actually be debt financed. There are other means to, you shouldn't finance a factory with VC money. So I think
Correct.
now we are seeing a next phase where you can actually coexist VCs and debt financing for building out factories and stuff and stuff like that. We have a company that doing like cement that's great for the environment, and naturally they will have to produce the cement at the end. They will have to build a factory for doing that, which is very, very capex intense, capex expensive. But there are other means of financing that. So I think us as a VC community, especially guys like us, we need to talk about we are open to investing in companies that not just doing software.
I mean, we can only do software. It's going to be very, I mean, or we need hardware. There is nothing to do. Actually, I think we need hardware more than software. But yeah, I mean, it goes to.
Look. For example, I think also it's a shame that we don't have semiconductors in Europe.
Yeah.
We're trying to build that out, but that's we missed out on that for 20 something years, and we see that's an issue where we created this ourselves because we haven't really invested in the. It's not like there hasn't been any semiconductor companies, but there not been enough funding for this type of industry. Now there are this huge project from European unions. They want to have a local semiconductor manufacturing for the geopolitical risk, etc., etc. But it's not like an industry that you can just flip a coin and then now we build a semiconductor factory. No, it's not that easy. So
simple.
I think we've done a disservice not investing in that type of companies for quite some time.
In Europe, we had this kind of very strong regulations behind almost everything. So it doesn't help at all. Competing with China and the US, it's very, very difficult. It's very complicated. Although we have such a strong talent, but they must be helped with everything, with money, with the environment, the rules, and the law, the economy behind as well. So we still are, in my opinion, we are at least 10 years behind US, at least. If not even before, if not even more. Sorry. Anyway, Johan, thank you so much for coming to the Investor Talk. Serious, it's been an absolute pleasure for me, and I'm completely sure funders will join so much this talk. Thank you.
Thanks for having me, Max. It's been a pleasure.